Have you ever looked at a commercial lease and felt completely overwhelmed? Triple net, gross lease, camp charges, what does it all really mean? In today's video, I'm going to be clearly explaining the difference between triple net lease and a gross lease, including exactly how those confusing triple net expenses are calculated so you can confidently decide what's best for your business. Let's dive in. First, let's talk about a gross lease. You pay a single predictable monthly rent, and the landlord covers property taxes, insurance, maintenance, and oftentimes utilities. It's simple, straightforward, and predictable. Let's say your gross lease is $3,000 a month, and that is it. That's your number. No surprise expenses at the end of the year. Gross leases are attractive for businesses that value stability in their monthly expenses and want to avoid surprise bills or additional charges throughout the year. It's especially beneficial for startups or small businesses that are still establishing their financial footing and prefer to have predictable costs. Additionally, under a gross lease, tenants typically have fewer operational responsibilities since the landlord manages most building-related services, allowing tenants to focus more on running their business. However, it is important to keep in mind that landlords often set a higher rent to cover any unexpected increases in their operating expenses, which means tenants could potentially pay slightly more than their actual share of expenses in the long run. Now let's focus on triple net leases, commonly called NNN, which is actually the most common type of lease in commercial real estate. With a triple net lease, you pay your base rent plus your share of three specific expenses: property taxes, insurance, and common area maintenance, which is also known as camp charges. Here's how it actually works. Let's say you have a commercial building that's 6,000 square feet. It's divided into 5 equal suites, each measuring 1,200 square feet. To calculate your portion of triple net expenses, you'll use your suite's percentage of the total building space. Since each suite is equal, each one occupies 20% of the building. How do we get that number? Simple math. Your suite size is 1,200 square feet divided by the building size of 6,000, which equals 0.20 or 20%. Now let's break it down. The total annual triple net expenses for the building. Property taxes, let's say they're 15,000, insurance 5,000, common area maintenance 10,000. That gives us a total of $30,000 per year. Now let's calculate your specific share. Property taxes, 15,000 times 20% equals 3,000 or $250 a month. Insurance, 5,000 times 20% equals 1,000 or approximately $83 a month. Common area maintenance, 10,000 times 20% equals $2,000 a year or approximately $167 a month. All these together equal your total triple net expenses, which are about $500. So if your base rent is $2,000, your actual monthly payment, including triple net expenses, would be $2,500. This calculation keeps things fair because larger spaces pay a bigger share and smaller spaces pay less. Keep in mind, triple net charges can change year to year depending on the property tax rates, insurance premiums, and maintenance costs. Always review previous year's triple net statements to predict your future cost. It's important to remember that under a triple net lease, tenants typically handle interior maintenance such as HVAC services, plumbing repairs, and electrical issues within their leased space. Also, landlords often reconcile expenses annually. This means that you could receive an additional bill or even a credit depending on whether your expenses were higher or lower than anticipated. Triple net leases are popular in commercial real estate because they clearly outline what each tenant pays and why. Landlords prefer triple net leases because they shift operating expenses to the tenants. Tenants often prefer them because base rents tend to be lower and they see exactly what they're paying for. Let's quickly review the pros and cons again. Pros: lower base rent, transparent costs, fairly distributed expenses. And the cons are: expenses can fluctuate yearly, additional responsibilities for the tenants. Which one is best for your business? If you prefer predictable monthly expenses, a gross lease might be simpler. But if you want more transparency, potentially lower base rents, and clear expenses, a triple net lease could be a better choice. Either way, always discuss and negotiate details like expense caps and maintenance responsibilities before signing your lease. If this video cleared things up for you, hit the like button and do not forget to subscribe for more commercial real estate insights. If you're looking for commercial space or have questions about your leases, reach out. I am here to help. Thank you for watching, and I'll see you guys in the next video.